Hello everyone and welcome to Fun with Fitzy. Today we are going to be talking about the expanded ledger. We've talked about the simple ledger so far, and just so you know, we are doing chapter 5 and we're doing 5.1. Through the first 4 chapters in this course, we have looked at the fundamental accounting equation, and you all know this by now. Assets equals liabilities plus owner's equity. This resulted in a single account for owner's equity. We've been using capital for everything, but that does not make sense. The types of owner's equity entries that we've been doing are when the owner invested in the company, he put cash in or assets, or when he or she made a sale or provided a service, or when they had expenses related to the operation of the business. For example, they had to fix the car or pay their hydro. And also, if the owner took money out, which we've been calling withdrawals, we've been putting all of these in the same account. The focus of this chapter then is to identify specific accounts to be used for each of these types of transactions. Okay, we're going to be looking at revenues, expenses, drawings, and owner investments in the company. As you can see, the capital account here on the left is what we've been using all along to put all of our transactions into. However, you cannot really tell if the company has been successful or not. Okay, so all of this information and the balance, this credit balance of $26,000, just goes into the capital account. So this trial balance or the balance sheet would tell us nothing about if they've had a net income or a net loss. So that's the same T account on the left. And here's what it really should look like if we had been using the expanded ledger. Okay, so this first number here was the owner's investment. Okay, and then things like this, when the owner withdrew money, he withdrew $3,950. There it is right there. That's where we put it. But in the expanded ledger, it's put in separate accounts. And because of this, you have one revenue account and several expense accounts, so you can clearly see where the company has been spending its money on expenses and where it's been making money. Okay, so we've had $23,660 in revenue. And if you subtract all of these expenses, you will be able to see whether or not they have a profit or a loss. Okay, what is revenue? We haven't talked about revenue a lot. Well, revenue is when a company sells goods or services, that is revenue. And revenue increases owner's equity. Okay, revenue is an increase in equity resulting from the sale of goods or services in the usual course of business. So when we mean usual course of business here, if you sell an asset, for example, a truck that you've been using in your business, that's not generally revenue, okay? We're talking about revenue from sales of your normal product, your merchandise, or providing services. Here's an example. A company is paid $500 for services they render. Before, we would have debited cash, just like this, and credited owner's equity. There's our equal debit and credit. Now, we're going to use a revenue account, so we're going to still debit cash, but instead of crediting owner's equity, we're going to credit revenue. Okay, so this is the expanded ledger. We're using other owner's equity accounts so we have more detail. How do revenue accounts behave? Well, we know assets have a normal debit balance, liabilities have a normal credit balance, and owner's equity has a normal credit balance. Well, let's look at revenue credit. Just like owner's equity. So things that increase owner's equity, like revenue, they will have a normal, it will act similar to owner's equity. So it's going to go up on the right. And if it were to go down, it would go down on the left. Okay, we would debit it. Just in summary here, revenue represents an increase in equity. An increase in equity requires a credit entry, and therefore, to book a revenue, that means to record it in our books, credit the revenue account, just like we showed you. The revenue recognition principle is really key, and we talked about GAPs and IFRS, and we've done this already before, but this is really key to understand. The revenue recognition convention states that revenue must be recorded in the accounts at the time the transaction is completed, or like I always like to say, when the revenue is earned, not necessarily when it's paid for. Okay, sometimes you provide a service and you earn revenue right that minute, but they don't pay you for 30 days. Well, you need to record that revenue right away when you've earned it. So that means when you send the bill to the customer is usually when you've earned it. That's when you record the revenue. And for cash transactions, you just record the revenue when the sale is complete and cash is received. So it's right then and there. Okay, let's talk about expenses now. What are expenses? Expenses are costs associated with producing revenue. What do they do to equity? Well, they decrease equity. As you know, a few videos back, I listed all the things that affect owner's equity, and when you pay an expense, this is a decrease. So before, we would have debited owner's equity. So an expense, you will see in a minute, is a debit, normal debit balance. Okay, so here are some examples of expenses. Company pays their employees. That's an expense. When you have salaries or wages, those are an expense. Before, we would have debited owner's equity because it's going down, and we would have credited cash because cash is going down. Now, instead of using owner's equity, we're going to use an expense account, but it's still a debit. Our debits still equal our credits here. How do expense accounts behave? Well, like before, we talked about this. So expenses decrease owner's equity, and that's a debit. So we're going to do the same thing, and we're going to have a normal balance of our expenses on the debit side. So when we need to record an expense, we're going to debit that account. Expenses rarely have a credit unless you're correcting a mistake. Okay, expenses decrease owner's equity. They're not good for the company. A decrease in equity requires a debit, and therefore expense accounts are typically debited, just like we're talking about. Okay, what is net income or net loss? Using the revenue and expense accounts, so just two of these owner's equity accounts. We don't use drawings and we don't use capital. Okay, just revenue and expense. Using those two, we can determine if they've earned a net income or a net loss. So basically, there's a little formula here for you. Net income is the difference between the revenue. So difference means subtract. So we're going to go revenue minus expense equals net income. It's that simple. Okay, the difference between the total revenue and the total expenses, where the revenues are greater than the expenses. So if revenue is greater than expense, you have a net income. If revenue is less than expenses, you have a net loss. Okay? What is drawings? The owner usually looks to the profits of the business to provide a livelihood, right? This is how they make their money. So in a healthy business, the owner is able to take funds generated by the profits out of the business. So when they take money out of the company, remember we said when the owner takes money out, it decreases owner's equity? Well, drawings is the account we're going to use when the owner takes money out or takes assets out of the company. They decrease owner's equity. They are not expenses. Do not put them on your income statement. They are not associated with producing revenue at all, okay? So expenses are associated with producing revenue. Usually you incur expenses in order to make money in your business. And therefore, do not put them on your income statement. They have nothing to do with the determination of net income or net loss. Cash is the most common item withdrawn by an owner, but they also take out other assets sometimes. Okay, so 4 types of accounts that we've looked at today. Capital. We will use capital now only as the equity figure and the beginning of the fiscal period plus new capital from the owner. So any investments from the owner goes into the account called capital. Revenue, this is an increase in equity resulting from the sale of goods or services. Okay, this has a credit balance. Both of these two have credit balances, normal credit balances. While expenses is a decrease in equity resulting from the cost of materials or services used to produce the revenue. This has a debit balance. And of course, drawings decreases in equity as well. Both of these have debit balances because they go on the left-hand side, decreasing equity. Okay, drawings is used when the owner takes something out. No longer use capital for any of these. By now, you should be able to name the 4 types of owner's equity accounts: capital, drawings, revenue, and expense. Determine what normal balances they have. Well, capital and revenue, oh, look at that. Capital and revenue have credit balances. That's the first time I've noticed that. And drawings and expenses have a debit balance. Isn't that interesting? Explain what net income or net loss is. Net income is when revenue is greater than expenses for the period, and net loss is when revenue is less than expenses. And the revenue recognition principle states that revenue must be recorded at the time it is earned, not necessarily when cash is transferring hands. Hope this helps.